developed international markets, as measured by the MSCI EFA index, which is representative of all developed markets excluding the U.S., have much lower valuations relative to the S&P 500. And in a historical context, we're near all-time lows based on a number of different relative valuation measures. This relative valuation is the main reason we believe investors should maintain some exposure to these markets. That said, we're maintaining an equal-weighted stance and not suggesting an overweight. This is mainly due to the risks and uncertainties with respect to a couple important factors. First would be negative interest rates, which leaves central banks with an empty cupboard should economic growth slow further. And then there are potential negative side effects that really have yet to be fully understood with negative interest rates. Secondly, we have trade risks. With the Brexit deadline getting pushed out, uncertainties remain, which makes it difficult for corporations to deploy capital, which is a key ingredient to future economic and earnings growth. And then the Trump administration is signaling the start of trade negotiations with the EU that could be contentious and possibly unnerving for the markets. Still, we see a lot of opportunity within the MSCI EFA index. The composition of the index is pretty complex. It's comprised of 21 different countries, more than 900 holdings, ranging from small cap to large. Broadly, Britain, Europe, and Japan make up the majority of the index, but the companies that make up the index tend to be global in nature. And this global patina has hurt earnings in the near term due to the slowing in global trade. With the Phase 1 trade deal with China, we believe it's likely that global trade becomes less of a headwind. It's a picture, it's a mixed picture, but given the relative valuation, we don't think investors should ignore EFA stocks in allocation decisions.